The ATM screen flickers, then goes dark. The man in front of you taps it twice, harder the second time. Nothing. He steps back, checks his phone, tries again. Behind you, someone mutters something about their card not working either. You pull yours out, insert it. The machine hums, then ejects it without a word. No error message, no explanation, just silence. You check your banking app. It loads. Your balance is still there, but when you try to transfer money, the screen freezes, a small spinning wheel. Then a message. Service temporarily unavailable. You refresh. Same thing. Someone behind you says their app won't open at all. You step away from the ATM. Look around. 3 other people are standing at machines nearby, all doing the same thing. Tapping, waiting, staring. No one's yelling yet, but no one's walking away either. This is a simulation. A thought experiment built on historical banking crises, institutional failure patterns, and the documented behavior of financial systems under sudden liquidity strain. We're not predicting the future. We're examining what happens when certain assumptions collapse at once. Specifically, what happens when trust in the banking system evaporates faster than the system can respond. In this scenario, Americans wake up on a Friday morning to discover that access to their money has been severed, not because their accounts are empty, but because the infrastructure that moves money has stopped moving. The question isn't whether this could happen. The question is what happens after it does. The trigger in this simulation is a cascade. It begins with the failure of a mid-sized regional bank, not one of the giants, something smaller. A bank with $40 billion in deposits, exposed to commercial real estate losses and underwater bond portfolios. On Thursday evening, regulators quietly seize it. By Friday morning, the news breaks. Within an hour, customers at other regional banks begin withdrawing cash. Not everyone, just enough. The fear isn't that their bank will fail today. The fear is that if they wait, they'll be too late. This is how it starts, not with collapse, with doubt. By 9 in the morning, branches across the country report lines forming outside. Tellers are calm. Managers assure customers everything is fine. And technically it is, for now. But the system isn't built for everyone to want their money at once. Banks operate on a fractional reserve model. They hold a small percentage of deposits in actual cash. The rest is loaned out, invested, tied up in assets that can't be liquidated instantly. When too many people ask for cash simultaneously, the bank doesn't fail because it's insolvent. It fails because it can't produce the paper fast enough. This is called a liquidity crisis, and in this simulation, it spreads faster than anyone anticipated. By 10, ATMs in major cities start running dry. Not all of them, just enough to be noticed. People tweet about it, post videos. Within 30 minutes, those videos have millions of views. The algorithm amplifies panic faster than any institution can contain it. People who weren't worried an hour ago are now standing in line, not because they think their bank is failing, but because they saw someone else's ATM reject them. Fear is contagious, and in the age of instant information, it moves at the speed of a refresh. The Federal Reserve issues a statement. Words like ample liquidity and temporary disruption appear. The president's economic advisor goes on television, calm, measured, confident, but confidence doesn't refill an ATM, and by noon, the lines are longer. What people don't realize yet is that the problem isn't just cash. It's the interbank lending system. Banks lend to each other overnight to balance their books. It's invisible, routine, boring until it stops. In this simulation, smaller banks start refusing to lend to each other, not because they're broke, but because they don't know who's next. Trust is the lubricant of the financial system, and trust is evaporating. By early afternoon, payment processors begin experiencing delays. Credit card transactions take longer to authorize. Some are declined outright, even for customers with available credit. Gas stations switch to cash only. Grocery stores do the same, but only at certain locations. The infrastructure is straining, not broken. Just slower. And in a system built on instantaneous settlement, slower is dangerous. People start hoarding cash, not in a violent way, just quietly. A little extra at the store, an extra withdrawal, filling the tank even though it's half full. Rational individual behavior that, in aggregate, accelerates the crisis. By evening, the government announces a bank holiday. All banks will close for 72 hours to ensure stability and assess system integrity. It's framed as a precaution. Historically, this is what governments do when they need to stop a run before it becomes irreversible. The announcement is supposed to calm people. It does the opposite, because a bank holiday means the government knows something is wrong. And if the government is worried, everyone else should be terrified. Within minutes, social media explodes. Comparisons to 1933, to Greece in 2015, to Cyprus, to every financial collapse in living memory. The phrase bail-in starts trending. People remember that, in some countries, depositors had their accounts frozen and partially seized to recapitalize failing banks. The fear isn't just about access anymore, it's about whether the money will still be there when the banks reopen. Saturday morning is quieter, but not calm. Banks are closed. ATMs that still have cash are emptied within hours. People begin improvising. Venmo and Cash app transfers spike, but those apps are connected to bank accounts. And if those accounts are frozen or inaccessible, the apps are just interfaces to nothing. Cryptocurrency exchanges see a surge in traffic. Some people try to move money into Bitcoin or stablecoins, but exchanges are overwhelmed. Verification takes days. Withdrawals are delayed. And for people who need cash now, crypto is too slow and too complicated. The ones who already held it are fine. Everyone else is locked out. Gas stations run out of fuel, not because there's no fuel, but because the just-in-time delivery system depends on electronic payments between suppliers, distributors, and stations. When payments freeze, deliveries slow. Stations that can't pay up front don't get refilled. By Saturday evening, half the stations in some cities have run dry. People with half a tank start worrying. People with a quarter tank start panicking. Lines form. Tempers flare. A few stations raise prices. Others impose limits. 5 gallons per customer. Cash only. The ones still accepting cards are overwhelmed. Some shut down entirely rather than deal with the chaos. Grocery stores are next. Shelves don't empty immediately, but certain items vanish fast. Bottled water, canned goods, bread, rice, anything with a long shelf life. It's not hoarding in the apocalyptic sense. It's precautionary buying, but the effect is the same. Stores can't restock fast enough because their supply chains are built on electronic fund transfers. Trucking companies won't deliver without payment guarantees. Warehouses won't release inventory without confirmation. The whole system is a delicate web of trust and instantaneous settlement, and that web is fraying. By Sunday, the silence is louder. No new announcements from the government, no clarity on when banks will reopen. People start talking to each other. Neighbors share information. Some offer help, others withdraw. There's a quiet sorting happening. Those with cash feel safer. Those without feel exposed. Small businesses that rely on daily revenue are paralyzed. Restaurants can't open because they can't pay suppliers. Contractors can't pay workers. Landlords can't access rent payments. Paychecks are delayed because payroll systems are frozen. The economy isn't collapsing in a dramatic explosion. It's suffocating. Slowly, quietly, one transaction at a time. Underneath all of this, something darker is unfolding. The biggest banks, the ones with Federal Reserve access and emergency liquidity lines, are fine. They have resources. They have backup systems. They have government guarantees. But smaller banks, credit unions, and regional institutions are struggling. Some will not reopen. Their customers don't know this yet. But the institutions do, and so does the government. In this simulation, the Federal Deposit Insurance Corporation is quietly preparing to take over several failed banks. The process is invisible to the public, but the consequences will be permanent. When those banks reopen, account holders will find their funds transferred to larger institutions, merged, absorbed. The banking system will emerge from this crisis more concentrated than before. Fewer banks, more control in fewer hands. Monday morning, the 72 hours are up. Some banks reopen, others remain closed. The ones that open impose withdrawal limits, $500 per day. Some less. Lines form again, but they're different now. Slower, more resigned. People aren't panicking, they're adapting. The new normal is setting in. You can access your money, but not all of it. Not when you want. Not in the way you're used to. This is the quiet part of the crisis. The part where the system doesn't break, it just changes the rules. And people accept it because the alternative is worse. Credit card companies extend payment deadlines. Mortgage servicers announce forbearance programs. Utility companies delay shutoffs. These sound like relief measures, and in some ways they are, but they're also evidence of how deep the strain runs. When every major institution simultaneously suspends normal operations, it means the system came closer to failure than anyone wants to admit. The crisis doesn't end, it pauses. And in that pause, trust is quietly renegotiated. People learn to hold more cash, to keep extra food, to assume that institutions might not be there when needed. The psychological shift is subtle but permanent. By the end of the first week, most of the immediate chaos has faded. Banks are open, albeit with restrictions. Stores are restocked. Gas stations have fuel. The worst is over, according to the news. But something fundamental has changed. The assumption that money is always accessible has been shattered. The belief that the system will always work has been replaced with the knowledge that it almost didn't. And in that knowledge, behaviors shift. Savings increase, spending decreases, trust in institutions declines, the economy doesn't collapse, but it slows. And that slowdown, sustained over months, creates its own set of consequences. Layoffs, business closures, recession. Not because the banks failed, but because people stopped believing they wouldn't. In this simulation, the people who fared best weren't the wealthiest. They were the ones who held diversified liquidity, cash, tangible assets, relationships, the ones who could operate outside the electronic system, even temporarily. the ones who didn't need the banks to function for 72 hours. Everyone else learned what financial fragility feels like, not as an abstract concept, but as a lived experience. Waiting in line, watching balances freeze, realizing that the money you earned, saved, and depend on exists only as numbers on a screen. And when the screen goes dark, so does your access. The system survived. It always does, but survival isn't the same as stability. And stability isn't the same as trust. The first 72 hours of a bank shutdown aren't defined by violence or looting or societal collapse. They're defined by confusion, frustration, and the slow realization that the infrastructure we take for granted is more fragile than we ever wanted to believe. The people who run the system know this. They've known it for decades. Every stress test, every contingency plan, every emergency protocol exists because the possibility is real. Not likely, but real. This was a simulation, a scenario built on mechanics, not prophecy. But the mechanics are sound. The history is documented. The vulnerabilities are known. The only question is timing. And that's the part no one can answer. So we watch. We prepare quietly. We hope it doesn't happen. And we remember that the difference between a functioning financial system and a frozen one isn't as wide as we'd like to think. It's just 72 hours, maybe less. If you found yourself watching this and thinking about your own situation, about what you do, about whether you're ready, you're not alone. That's the point. Subscribe if you want more simulations like this, more explorations of the systems we depend on and what happens when they stop working. Because understanding the mechanics of collapse is the first step toward avoiding it, or surviving it. If this moment ever arrived where you live, what would it mean for you?